So today I'm going to have the 3 financial statements basics explained fully to you so they can understand how to pick profitable stocks and also use this for your personal life. We're going to talk about that today, coming up next. So when I was studying for my finance degree, it took me 6 months taking 2 accounting modules, 3 months studying financial statements alone. So when I was studying for the accounting modules, we learned how to balance a balance sheet, whereas for the financial statements modules, it's more for checking whether a company is a good buy, whether a company is rigging its numbers. But you need to know these 3 main financial statements, okay? So the first one is your income statement. Okay, some people call it the profit and loss statement, or some people call it short form P&L. Okay, so when people talk about P&L, they are referring to the income statement. So this is the first one you need to understand. Then the second financial statement you need to understand is your balance sheet, okay? And of course, the third one is your statement of cash flow, okay? Or the cash flow statement. Now, if you have read Robert Kiyosaki's book, you know that he mentioned if you want to become financially literate, the most basic thing is you must understand these 3 financial statements, how to read financial statements. Because there are certain things that the rich do that makes them become really rich. There are certain things that the middle class do that makes them become stuck. And if you can understand financial statements really well, you know how the money flows to their pocket. Then everything will start to make sense easier, okay? Okay, so the first financial statement. As the name suggests, why is it called profit and loss statement? Is because it tells you what is the profitability of the company and also what is the financial strength of the company. Are they able to make money consistently over the past few years? And hence, you can more or less predict in the future, are they going to continue making money? And also, what is their financial strength? Can they withstand financial recessions? So most of the time when investors want to see whether they should invest into the stock or not, one of the most important factors is the company profitable or not? If you are to craft your own personal income statement, it might look something like this, okay? You have your salary that's coming in, okay? And then when you got your salary, if that is your only income, you need to use it to pay your expense. So hence, once you minus off all your expenses, your rental, your car payment, to feed your dog, you would have some extra savings. And hence, this is your personal P&L. For us individuals, it's a lot more simple, but for companies, there's a lot more things than this. So when company earns money, they would have sales revenue coming in, okay? This is money that they earn when they sell their products, when you sell your service. Let's say, for example, you sell handbags. The money you earn from selling handbags would be your sales revenue. And of course, to produce those handbags, you need to put in upfront capital to pay for your raw materials. And when you pay for the raw materials, this will come under, okay, cost of goods sold. In short form, most people call it COGS, okay? So when you have your sales revenue minus COGS, you would have your gross profit. And when you run the business, you need to pay staff, pay for your shop rental, admin expenses. All those expenses would come under here. And of course, people classify it into many different types of expenses under here. I'm not going to go into that because it's going to confuse you. All the operating expenses, sales expenses, admin expenses is classified under here, okay? So once you minus off your expenses, then this is the so-called your personal savings, which is your net income or your net profit. This is like your salary, okay? Then this is like your personal expenses. After you paid off everything, you have some extra savings, which is your net income. So if you're a stock investor, you're evaluating a company, ideally, you want this company's net income to increase every single year. You want their sales to increase every single year. Of course, with increased sales revenue, with increased net profit, your expenses would increase, correct? But you want to make sure that the company is able to maintain the expenses and not increase it too much. I'm going to talk more about this in a video on how to pick stocks, but for now, just understand that this has to increase and this has to increase, okay? So the second financial statement that you should know is the balance sheet, okay? So what it does is that it provides you a snapshot of the performance during a certain period. So how does this differ from the income statement? What do stock investors normally use this for? What does this really tell you? It's possible that on a personal level, you might be earning a salary every single month, but if you count your net worth, it is negative. That is why we need to look at the company's net worth. And this is what the balance sheet is going to tell you. So when do stock investors look at balance sheet? They pay more attention to the balance sheet when there's a recession. Why is that? Because the balance sheet tells you how liquid the company is. Do they have sufficient liquidity in their company for them to withdraw cash so that they can withstand temporary recessions? And it also tells you the solvency of the company. So again, on a personal level, how do you calculate your net worth? You look at your balance sheet, okay? All of us, we have assets, okay? Short-term assets, long-term assets. On the personal level, for us, our short-term assets or current assets are liquid assets, okay? Like your cash. Then the non-current assets can be, for example, property that you rent out, that you don't live in. Now, why do I say it's property that you rent out that you don't live in? Because a lot of people think that, oh, the house that I live in is an asset. Now, here's the thing. When you're paying for the house every single month, money is coming out of your pocket. Your house is not an asset. Your car is not an asset. If you're paying for the fuel every single month, if money is coming out of your pocket every single month to pay for the car doesn't generate you any money. Your car is a liability. So your personal asset minus all your liabilities. Liabilities can also be your credit card loan, money that you owe to people. Once you paid off of that, then you have your net worth. For individuals, it's a lot simpler, okay? But for companies, again, they have more specific things. For companies, you have your assets, okay? The same thing. They have their liabilities. But instead of net worth, it is stated as shareholders' equity. So to put it simply, assets are something that has value and can be converted into cash. Liabilities is something that you owe to other people. Money that they owe to suppliers, to creditors, is classified under liabilities. So you need to understand this formula, okay? Assets is equal to liabilities plus shareholders' equity. And then shareholders' equity, how is it calculated? Shareholders' equity is actually share capital plus retained earnings. Or some people call it, they use the short form, they use RE. So assets is actually equal to liabilities plus share capital plus RE, retained earnings. So if you look at this retained earnings, This is what a lot of investors, shareholders focus on, because after all, your shareholders' equity, this is your shareholders' equity, companies can determine whether do they want to reinvest this retained earnings to further grow the company, or they can pay it to their shareholders in the form of dividends. If you're a dividend investor, you would want this to happen. You would want the dividend payments. But if you're a capital gain investor, you wouldn't really look or care about the dividend payments. You would want the company to reinvest back to the company so that they can grow the business using the extra savings that they have. Now, some you call retained earnings, retained profits, or accumulated profits. Basically, it just means the same thing. It is extra money that the company has in which they can choose to reinvest or pay their shareholders. Okay, when it comes to analyzing balance sheet in detail, I'm gonna reserve that for future videos because I don't want to confuse the beginners too much. But for now, the third financial statement is the statement of cash flow. So basically, this financial statement tells you what is the cash inflow and also cash outflow of the company. Now, the statement of cash flow, a lot of investors feel that's very complicated, but actually it's quite simple if you really study it properly. To put it in summary, it measures how much cash is flowing to the company at this point of time, and also how much cash is flowing out of the company at this point of time. Basically, when we look at statement of cash flow as stock investors, we want to look at whether the company has free cash flow for it to pay for expenses and also to overcome temporary disasters which they need to pay for. When the company is generating net profits, it doesn't mean that they have available cash on hand right now to pay for unnecessary expenses. It's because in accounting, when accountants recognize a sales revenue, a sales made, it is recognized at the point in time in which it is incurred, not when the payment is received. You know what I'm saying? It means that the company could sell a bag on credit. It means that the customers is going to make payment in cash in a few months' time. But the company has already recognized the revenue in their P&L. So if all the company has is selling by credit, accumulates tons of accounts receivable. After your minus expenses and gross profit, okay, then it would seem like a company is generating money because their net income is increasing every single year. But do they really have cash on hand? You'll find that out using statement of cash flow. Okay, so if you look at a statement of cash flow, you will see three things, okay? Cash flow from investing activities, cash flow from operating activities, and then cash flow from financing activities. So cash flow from investing activities is cash flow that's generated from, let's say, if the company purchases assets, if they invest in equipment, okay, it will fall under cash flow from investing activities. So cash flow from operating activities is basically measures the money that goes into and out of the company because of daily operating activities. Cash flow from financing activities is used to measure is cash flow that's used to finance the company's cash flow. If I give you more examples in the next few videos, I'll show you cash flow statement, you'll get a clearer picture. For now, just understand the basic terms first, okay? So to put it in summary, what this tells you is, it helps you differentiate, is the company a cash cow? Or is the company just keeping all the cash to themselves? Or are they cash hawks? Okay, so if that, let me know down in the comment section below. What do you use financial statements for your personal life? Do you use it to pick stocks, or do you use it for your own personal finance? Okay, let me know. So with that, I'll talk to you in the next episode. Bye.